When investors talk about equity, they mean ownership of companies. When economists talk about equity, they mean fairness. Fairness isn't the same as equality. If we have a cake to divide, sometimes the fairest way is to give everyone an equal slice. But if someone is starving and everyone else already ate 5 cakes, then it's not looking that fair to give the dying person just one slice. Equity is a big concern for economists, and it arises because factors of production are unequally distributed. So the rent, wages, interest, and profit paid to factors of production owners flows towards a small proportion of the population. The very wealthy tend not only to be high skill and thus have high incomes, they also own capital and land. This means they earn a lot of passive income by letting other people pay to borrow the stuff they own. And having all this passive income means they have more time to be entrepreneurial, which can pay the biggest rewards of all factors. Since factors are unequally owned, free markets inevitably result in unequal income flows. And this means both absolute and relative poverty, where the distinction is drawn by absolute poverty being a question of survival, whereas relative poverty can be experienced by a millionaire in a room full of billionaires. Poverty is caused by low income, low employment, and low skills, which create low living standards and lack of healthcare and education. This creates a vicious circle where one generation passes poverty to the next, and is known as the poverty cycle. Economists measure equity or income inequality using 2 related metrics, the Lorenz curve and the Gini coefficient. The Lorenz curve plots quintiles of the population against percentage share of national income. Start by ranking the population of a country by how much each person earns as a percentage of the total income. Then group that population into fifths, so that 20% of the population is in each group. This gives us 5 quintiles. The bottom quintile is the poorest, earning the lowest percentage of national income, while the top quintile is the richest. If the country was perfectly equal, then every quintile would earn the same percentage of national income. If the country was perfectly unequal, then the top quintile would earn 100% of national income, and the other 4 quintiles would earn nothing. By placing the quintiles on the x-axis, you have 5 x-axis points to plot. On the y-axis, you plot cumulative share of national income. It's important that this is cumulative. Now, your perfectly equal country is a 45-degree line with positive gradient, whereas your perfectly unequal country is a right angle into the bottom corner. This is the Lorenz curve for a country. The more unequal the country, the greater the distance between the country's Lorenz curve and the line of perfect equality. This is a great way to visualize differences between one country and another, or the same country over time. Whereas the Lorenz curve is visual, the Gini coefficient is a number. To calculate the number, you take the area between the country's Lorenz curve and the line of perfect equality, call it A, and divide it by the area made by perfect inequality, call it B. The result is the Gini coefficient. The lower the Gini coefficient, the more equal the country. So how can economists fix inequity, which is another way of saying an unjust distribution of income? The answer is taxes. And this explains why rich people are always banging on about taxes. The whole point of taxation is to promote equity, which is just a fancy way of saying make the poor less poor by making the rich less rich. And rich people don't want to be less rich. Taxes can be placed on the things we buy, and these are called indirect taxes, or on the money we earn, and these are called direct taxes. The reason for these labels is to highlight how avoidable the tax is. You can avoid indirect taxes by buying fewer goods and saving more, but you can only avoid direct taxes by earning less. Direct taxes hit you directly, rather than indirectly, by targeting the things you buy. Since poor people spend almost all of their money on necessities, they cannot avoid buying these things when these things get taxed. They just keep buying. However, rich people can avoid indirect taxes by buying less, because rich people spend a lot of money on unnecessary things, like gold-plated Ferraris. When those things are taxed, the rich just save more and stay wealthy. This makes indirect taxes regressive, which means that poor people are hit harder than rich people. When rich and poor are hit equally hard by a tax, then we say that tax is proportionate, and the opposite of regressive is progressive. So we've highlighted that indirect taxes are likely to be regressive because the poor cannot avoid them, whereas the rich can. This makes direct taxes a better way to redistribute wealth and income. And most governments around the world have progressive taxation systems, where the percentage rate of tax paid is rising as your income rises. So not only does the total amount of tax paid rise, but the percentage rate of tax rises too. And this is what makes it progressive. The poor pay less as a percentage of their income than the rich. The tax raise is often used to give transfer payments to the poor, where transfer payment is another word for subsidy, an example of which is the welfare system. And tax revenue is used to provide merit goods and public goods from which the poor benefit. And it is by providing public services and social security in this way, especially state pensions, social care, healthcare, infrastructure, water, education, sanitation, police systems, that governments spend the largest proportion of tax in pursuit of the goal of equity. The final thing to consider is the impact of taxation on the efficiency of the economy. Rich people usually complain that taxes are a disincentive to work. And it's usually true that if you lower someone's wage, they will work less, meaning that increasing taxes on wages will reduce the labour supply and shift the LRAS curve inwards. However, when it comes to the rich, the situation is arguably quite different. By increasing taxes on the rich, we may reduce the rate of early retirement by high-skilled people in the economy, and this will actually increase the labour supply, shifting the LRAS outwards. Moreover, by transferring wealth from rich to poor, we will see an increase in consumption because poor people save less and spend more than rich people. So by moving $100 from a rich person who is saving it to a poor person who will spend it, we will increase aggregate demand and thus stimulate employment, investment, and economic growth. Finally, allocative efficiency means placing resources where they create the most social utility. And it's pretty clear that $100 creates more benefit for a homeless person than for Bill Gates. He won't even notice it's gone. Suffice to say that the trade-off between equity and efficiency that is presented by right-wing political parties is not at all straightforward. Increases in equity may actually increase efficiency at the same time.